The broadcast is now starting. All attendees are in listen-only mode.
Good afternoon, everyone. My name is Joe Bicella, Director of Client Success at Chaikin Analytics, and I'd like to welcome you today to our presentation of Expert Stocks and Options, a special two-part presentation by James Romelli and Mark Chaikin. Our first presenter this afternoon is James Romelli. Mr. Romelli is a trader and options educator at keenonthemarket.com, where he actively trades futures, equity options, currency pairs, and commodities. As one of the moderators of the live trading room, Romelli educates members on strategies, trade setups, risk management while trading his own capital. Mr. Romelli is regularly featured on Bloomberg TV, BNN, CBOE TV, in addition to writing a weekly column for Futures Magazine and being featured on CME Group's Open Markets as a guest contributor. Romelli holds a BS in finance with a concentration in derivatives and financial engineering from the University of Illinois, Urbana-Champaign. To get us started, here's James Romelli.
Thank you so much there for the introduction, Joe. How is everybody today? Are we all still awake after watching what was probably one of the most boring sessions in the S&P futures I've seen in the last couple of weeks? Very slow trading today, but even with that being the case, there was still some pretty interesting trades to come across the tape in terms of unusual options activity. And that's what we're going to be talking about today is unusual options activity and how retail traders can use this information to get a leg up and compete with the institutional guys in a meaningful way. So before we get started here, I do always like to do a little bit of a survey and get a baseline of what your guys' understanding of unusual options activity is. So before we jump right into the presentation here, how many of you have never ever heard that term before, unusual options activity, or have never ever been really acquainted with what it is as a concept or as a trading idea? A lot of you saying, yes, I've heard of it before, not aware of it, never heard of it. Never. Good. So a lot of you have never heard of this idea before, which is great. So that kind of gives me an idea of how to go through this. So with that being said, let's jump right into the presentation here. Before we do, I always do have to read our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with limited capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades or recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution margin and all other capital requirement questions. Everyone watching this presentation adheres to all disclaimers on optionhacker.com and alphashark.com. So I'm not going to spend too much time talking about myself because Joe did a great job of introducing me, but my name is James Romelli, and I'm an active trader and educator here at Alpha Shark Trading, where I trade equities and equity options for the most part, regularly on CNBC, Bloomberg, Fox Business, and BNN Canada. So if you see me on TV, thank you. And if you haven't, maybe you've read something I've written. I write for Futures Magazine, Active Trader Magazine, Resource Investor, CME Open Markets, and probably about a dozen other online financial news publications. So enough about me. Let's talk about why we actually care about unusual options activity. And all of our trading plans seek to solve the same problem. And the problem is most retail traders lose money. And why is that? And it is a sad statistic that 90% of all retail traders lose money if they are actively trading. And if you are a retail trader who opens up a new account with the idea to actively trade options, stocks, futures, or Forex, typically speaking, 18 months from today, you will not be able to do that anymore because you will have blown out your account or you will have moved yourself to a level of capital that is not sufficient to do that type of thing anymore. But at the same time, most institutions make money trading actively, and we want to know why that is. Why is it that institutional traders do better than the retail trader and on average make way more money? There's firms here in Chicago that haven't had a losing trading day in the last 5 years. And I know that sounds a little unbelievable, but it's true. They haven't had a single daily drawdown in the past 5 years. And we want to examine the reasons for that and how we can use the information that they have that we don't necessarily have access to our advantage. And this is where we enter into unusual options activity. It lets me see what the biggest traders in the world are trading at any given time. So guys like Carl Icahn, Bill Ackman, David Einhorn, if you don't know who they are, they're all very successful hedge fund managers, and they are successful for reasons that retail traders can't really compete with. They're successful for the access that they have. They're successful because of the amount of capital that they have. And they're also successful because they have a really good level of trading knowledge. But at the same time, what we really want to know is what are the actual advantages that drive the success that institutional traders have in equity options trading specifically. And they all come from this one place right here at the bottom. And a lot of you saying right away when I asked that question, what is it that makes them more successful? Most of you are saying it's because they have more money. And to a large extent, that is true. They're successful because they have capital that gives them access to things that retail traders cannot access. The main things being manpower, technology, and information. So let's start here with the first point on this list, information. How many of you out there think that institutional traders, meaning the guys at hedge funds, mutual funds, and big banks, rarely ever use insider information or non-public information that they're not supposed to have to set up a trade? How many of you guys think that that never ever happens? Does anyone think that it rarely goes on in the institutional trading world, insider trading? Yeah, most people when I ask that question respond with a yeah right or a hilarious idea type of response. And that is true, right? We see them getting in trouble all the time for it. That does happen pretty often, right? But let's for a second assume that it never happens, that they're only using the publicly available information that they have out there that's in the sphere of all information that is available to them. Anyone who can, go and look at a company's prospectus and look at their financials, all of that type of stuff. If that's the case, they're still at a huge advantage over the average retail trader because of their ability to process and analyze all that information. How many hours do you guys spend outside of regular quote-unquote market hours every week going over charts, looking at financial statements, reading articles about companies that you're trading, coming to presentations like this to learn new ideas? I would imagine, because you're all here now, that it's a significant amount of time. You all probably spend a fair amount of time outside of market hours doing that type of quote-unquote homework. And unfortunately, even if you do spend 100 hours, you're never going to be able to compete with the hedge fund that has a team of quantitative analysts at their disposal. The technology and manpower that they have access to process that even publicly available information is so much greater than anything I can hope to compete with. So it puts me at a big disadvantage right off the bat, right? But once we add back in the idea that they can and do oftentimes use insider information that they're not supposed to have, then we know that it's really kind of an uphill battle to compete with these guys. But fortunately for us, unusual options activity can give us the window into what's going on in the institutional hedge fund machine here, because no matter what they're using to do their analysis or make their thesis come to light, it all ends with the same exact end result. And that same exact end result every time is a trade. And it's a trade that they're going to execute in the equity options market. So if I'm able to identify the trades that are coming from these institutions and these big players in the market, well, then it doesn't really matter that I don't have access and can't compete with them in these categories here. I'm able to flag their trades and profit off of their hard work, or at the very least, get an inside look at what institutional money and the largest traders in the world are thinking about the market at any given time. Okay, so this is what brings us into unusual options activity. Unusual options activity is driven by this institutional order flow, and the institutional order flow that drives unusual options activity gives me a whole lot of insight into what big money is doing at any given time. And it's pretty simply defined. Unusual options activity is any order in the equity options market that is above the average daily volume in that given stock. So if a stock normally trades 2,000 equity options a day and a trader comes in and buys 5,000 out of the money calls, that would be considered unusual options activity, and it's something that is worth a second look from me, because those are the orders that give me insight into where big money is pressing their bets on any given day, right? So I can watch the equity options market and look at order flow in equity options to determine where they're coming in and picking up longs on a day when the market is down, where they're pressing shorts on a day the market is down, where they're coming in and fading movement in stocks that are happening. And it also gives me a heads up when they might be expecting a huge outsized move in a certain stock. It lets me as a retail trader see where this quote unquote smart money is going at any given time. And there's a reason why I look at the options market over the equities market for this type of information. The order process in the options market makes it very difficult for them to quote unquote hide or bluff with their orders. And once we think about how the process actually happens, we can understand that they really can't sneak an order by the trading public if we're watching the tape and looking for unusual options activity. So after they do all of that analysis, all of that research, and they come up with an idea for a trade, they will then try to get their order filled. And when I say they, I mean the institution, the hedge fund, the large activist investor, or the big investment vehicle that we're trying to figure out where they're putting their money. They're going to try to get their trade filled, and they're going to call their broker, and their broker is going to try to get them their order filled. And they might do it on the floor, they might do it off of the floor, they might call market makers around the country and around the world to get their order filled, or if the broker has a really good relationship with their customer, they may just choose to go right ahead and fill their order for that customer. But what's important to understand is that at no point throughout this process are they able to send their order to a dark pool. Does anybody not know what a dark pool is? A dark pool is simply a center of off-exchange liquidity where big institutional and large traders can come and transact with each other without their order flow or price action being represented in the charts that you and I might look at on a daily basis in Thinkorswim or TradeStation, Options House, Trade Monster, or anything like that. What's great about equity options is that no matter where this order is filled along this process, they do not have the ability to send it to a dark pool, so they have to have their order filled on a public options exchange. The NYSE, the CBOE, the PHLX, the Miami Options Exchange, the Boston Stock Exchange, any of those places, they can get their order filled on. They don't have the ability to kind of hide that in a center of off-exchange liquidity like big institutional equity traders are able to. So what this means is that every single time a large equity options order is placed, I'm going to be able to see all of the pertinent and relevant information surrounding that trade, and I'm going to be able to tell exactly what it was they were doing in terms of buying and selling. Now, it's not just as simple as looking for large orders, hitting the tape, and buying the exact same options instantly. We're going to get into that a little bit later, but this is exactly why we care about unusual options activity. And people ask me all the time, what kind of stocks can have unusual options activity? How come we in our trading room never trade Apple or Google or Netflix based on options order flow? And the reason for that is because it's very difficult for those types of stocks to have quote unquote unusual order flow because they trade so many options in a day. So what would it take to move the needle in terms of options volume in a stock like Apple, in a stock like Facebook, in a stock like Twitter? It would take a whole heck of a lot of options to do that. There's over 4,000 actively traded equities on the NYSE and the NASDAQ and 15,000 that trade off of major exchanges. But I will take a trade in any stock that represents a good opportunity for me based on unusual options activity. Any of those stocks that are optionable can, in theory, have some type of unusual volume in a day, right? It's a lot easier for some of them to have quote-unquote unusual activity because they don't trade very many options, but for some it can be a little bit more difficult. The point is that any stock out there that has options falls into my wheelhouse and my potential list of stocks that I could trade for earnings, okay? And now let's take a look at exactly what this order flow actually looks like. And what we have here is an example in Boeing, an example of options that hit the tape on December 17th. And this is exactly the information that we are given by all of these public exchanges at any given time about all trades that cross the tape in their venue. And don't get too hung up on the format of what you see here, the colors and the fonts that you have, because not every single data provider is going to give it to you in this format. This little snippet comes from a scanner that we use called Trade Alert, but Thinkorswim and TradeStation have their own options scanners built into their platforms. It's not going to look like this when you see the order flow that we're talking about, but all of the information that is relevant to the trade will be provided to you. And what we're able to see is the size of the trade, the time it took place, whether it was bought or sold, the stock it took place in, the expiration, the strike price, whether it was a call or a put, the price it traded at, the market at the time of the trade, whether it was an opening or closing position, and the price of the stock at the time the trade took place. Now, what is something that I noticed right away about Boeing here? What do you guys think makes this such an unusual position for a trader to do in Boeing? Well, if I didn't know when this trade was coming across the tape, I would probably look at it and say, hey, you know what? This doesn't really seem like that unusual of an order in Boeing. 3,735 contracts is a whole lot of options, but Boeing is a heavily traded stock, right? It's something that people are paying a lot of attention to most of the time. Now, this is a $205,000 bet, but if I tell you that this trade was placed a day before options expiration, does it become more or less interesting to you as a trader to know that institutional money out there is coming in with less than two full trading days left until expiration and betting $200,000 that Boeing is going to be lower on expiration the next day? Well, let's take a look at the way this trade actually played out. Here we have the day that they bought these puts. This is Boeing on the daily bar. We can see that a trader came in and bought those puts on this day here, the day that we had this big red candle. Now, they bought those pretty early in the morning, and if we take a look here, we can see they bought them at 10:33, so just about an hour or so past the open of regular trading on the day that this order came across the tape. And take a look at the way the stock traded throughout the rest of the day. Well, the stock sold off pretty hard after these options hit the tape. But what's really interesting and really kind of unique to unusual options activity is that because I saw them buy those puts, I can pay attention and wait for them to sell them and get an idea of how much more the trader thinks the trade has in it to run to the downside. So even though this stock sold off well below 147, I think you can see there it closed at 145.56 on this day, the trader that put on these puts did not exit their position. So they more than tripled in value over the course of one trading day, which is a fantastic return for any day or swing trader. But at the close that day, by the close that day, they didn't exit their position. So what does that tell me? It tells me that they believe that the stock has a whole lot more downside than it has already experienced. And if we take a look at the way that it traded the day after this, boom, the stock gaps lower and gets absolutely crushed throughout the next day's session. The stock sold off 4.1% by the close the next day, which was options expiration for these, and the traders sold their position. We were able to see them exit their puts because we saw the puts being sold hitting the tape, and they exited them for $7.85. Now, when you look at this, what do you guys think is the most likely scenario here? Did this trader just happen to get lucky, or did they know that there might be some news coming out in Boeing the next day that would cause the stock to fall aggressively like this? And in case you're wondering what that news was, there was an announcement that Boeing was being downgraded. It caught 2 downgrades that day. So what do you think is more likely here? Did they just so happen to get lucky and bet 200 grand the day before the downgrade happened, or did they know something ahead of time? And most of you are saying that this is something where they knew what was going on, right? Someone says, so you're saying we would buy the put that they had sold? No. So basically what I'm saying is I would flag that Boeing put buy as an opportunity to get short Boeing, okay? So I see them betting this huge amount of money in capital for one day that Boeing is going to sell off. And then it sold off very hard the next day on a catalyst event, which happened to be a downgrade, right? So look at this chart all you want. Talk about the technical setups that we have here. We have a triple top. Someone mentioned that as well. But what really drove the sell-off and got these things from 55 cents to 7.85 was not the technical development, but it was the piece of news that came through, right? And it was the news that drove this thing lower. So it becomes really kind of obvious that this trader probably had a good idea of what the announcement was going to be the next day and that Boeing was going to catch those downgrades. If I would have bought a 20 lot of these puts and held them through the trader's holding period, which would have signaled me to exit the next day near the close, I would have made $14,600 on a 20 lot of these puts. This trader made a whole lot more than that, right? They bought 3,735 of these and made $7.35 per one lot on this. So they made about $2.75 million overnight. Now, is this trader going to get a call from the SEC? Possibly, most likely not. But this just goes to show you how you can look at this unusual options order flow and get ahead of moves like this, right? He had inside information. He may not have. It seems more likely that he did. I don't want to trade with insider information, but I will certainly use the equity options order flow to get ahead of a move like this in Boeing. Let's take a look at another example here. A trader came in and bought 15,000, or nearly 15,000 of the PMCS Jan 7 calls for 85 cents when the market was 60 bid at 85. Now, a couple of things stand out right away about this trade. First of all, it is a huge bet in PMCS. This is a pretty cheap stock. The trader came in and bought the Jan 7 calls for 85 cents. In this size, it equates to about a $1.25 million bet through January. Now, when we look at options order flow, $1.25 million might not seem like a whole lot of capital for someone to bet in a position or to put into a position, right? In the stock market, that would just be a drop in the bucket. But when we're talking about equity options order flow, that's significant, right? Some trader out there is willing to make a $1.25 million trade in derivatives that PMCS is going to be significantly above $7 come January expiration. And it becomes fairly obvious why they did this trade 2 days after the order hit the tape when PMCS announces they're going to be acquired in an all-cash deal and the stock gaps to the upside. These calls have moved to $3.33 in this very session, meaning that at the highs of that session, the day that they announced this trader was up over $3.6 million in just 2 days. A trader that would have bought a 20 lot of those calls would have profited $4,900 on only $1,700 worth of risk. And this trade still isn't over with. The trader has yet to exit their position, right? So as a retail trader, if I got into these with the trader that bought them in the first place, I'd be keeping an eye out for when he gets out of them. Does he think that there is a chance that there's more upside here? And they didn't exit them. That is what's really important to understand here. This goes back to October. They still have not exited this position. Take a look at the options chain here for PMCS. Every single one of those 14,000 contracts is still open. And take a look at, nearly every one of those was still open. They exited them now, but they're trading 450 at 470, and they've actually rolled their position up to the 10s because another higher bid has come into this. So this trade has been even more profitable since the initial catalyst gap to the upside. Okay? Yeah, I mean, that is a ridiculous move to the upside there. And I can ask you guys again, and I think I probably already know the answer to your question. What do you guys think was the most likely situation here? Did this trader just so happen to put on a massive bet in PMCS and get lucky? Or did they happen to know that the announcement was going to be coming down the pipeline, that PMCS was going to be acquired in an all-cash deal? Did they know that the deal was going to happen? Yeah, insider corruption, right? Everyone pretty much agrees that this trader knew what was going on, right? They knew what was going on. And someone's saying, well, how do we get that info? Well, for one, I don't want the info that the trader has, right? Because he's using inside information to do this. I don't want to know what he knows. What I want to do is pick out the equity options trades like Boeing, like PMCS, that signal that something suspicious is happening, that something might be going down in this symbol, and it's something that I might want to pay closer attention to, or something that I want to trade right alongside this trader. Right, and that brings us back to why it is we actually pay attention to these trades. Hedge funds and big traders happen to have more information than us. They do. No matter which way you kind of dice it, they're trading with more information than I can hope to have access to as a retail trader. Whether or not you believe that that information is inside information, and I think that most of us probably do believe that at least some of the time institutional traders are using information that is non-public, that they're not supposed to have. or whether or not you believe that they are using publicly available information, we know that their order flow is significant. We know that it's important because it tells us where big money is positioning themselves in any given name at any given time. Hedge funds and big traders have more information than us. Even if they're only using public information, they're always going to be able to do a more thorough and higher level analysis of that information than me or William or Sherry or Brian are going to be able to do on our own, right? Even if you're the most savvy Googler out there and you're able to collect all of the publicly available information inside of the sphere of information that's available out there, one, I don't even think you would have the time to do all of that before putting on a trade. Two, you wouldn't have the resources to kind of analyze and crunch up all those numbers, right? A lot of us probably don't have the expertise that hedge funds have at their disposal, right? They have people that are experts at accounting and experts at financial statement analysis, all working towards one end goal, which is to come up with an idea that they can then go into the equity options market and change, okay? So it is like being able to see where Carl Icahn or David Einhorn or Bill Ackman or any of those guys are positioning themselves in the market. And it also kind of lets me see things that I wouldn't necessarily get to see if I was just looking at order flow in the underlying equity, right? Because options allow traders to express a whole myriad of different views, and you don't quite see that come through in equities order flow, okay? Someone says, how much liquidity is there when the PMCS trader bought the 14,000 calls? The total open interest for the Jan is around 17,000. Well, the open interest that was in that line of calls when they bought them was only 318 contracts. But what's great about the equity options market is that it is massive. It is so liquid. So what happens is they want to get that order for almost 15,000 calls fulfilled, right? And what they're going to do is they're going to tell their broker, hey, we need 15,000 of the PMCS Jan 7 calls. Go get them for us. And the broker is going to get that order filled for their trader. Now, they might go to the floor and say, hey, or to call up a market making desk and say, hey, we need this many, make a market, and they'll get filled. The thing about equity options is that the market makers just want volume. They want to do as many trades as they can. The guy that sold those calls to that trader that made all that money in PMCS, he doesn't care at all that the stock gapped to the upside the next day. He didn't lose any money because as soon as he took down that trader's position, he went into the stock market and hedged himself. Okay? Yes, I do believe this is recorded. All right, so one of the things that someone pretty much always asks me when we do this presentation is if they're using inside information. Oh, that is a fantastic question, PJ, and I will actually stop myself there so I can address it. Someone says, how can you tell when the trade is a directional bet versus a hedge against an existing stock position they might have? And we're going to get into that in the next couple of slides here, PJ, because like I said, not every single large trade that comes across the tape is an actionable play because a lot of the equity options market participants are simply in the equity options market to hedge their existing stock positions. And we're going to talk about how I can do some analysis and figure out with the best guess whether or not that is the case, okay? So the trades that hit the tape are all public information. So whether or not the Boeing or PMCS trader knew that this was going to happen in those positions doesn't really matter to me because as soon as their information, their order flow hits the tape, they are automatically considered to be public information, right? And I can use that information any way I so please. And I can use that to determine that I think that, hey, there's going to be a big move in Boeing by tomorrow, or that, hey, there's probably something going on in PMCS. This trader is getting really long in out-of-the-money calls. All right? So with that being said, I want to jump into the trading plan here and how we talk about actually doing the analysis and figuring out which of these trades are actionable. But before I do, does anyone have any other questions about anything we've talked about so far? Are we all pretty clear on what the concept of unusual options activity is now? Because now I'm going to jump into the trading plan itself and talk about how we actually analyze order flow that hits the tape to determine which trades are the best and highest probability speculative bets. So does anyone have any questions before we move on here? Any questions at all? Any questions? Where do you find the unusual options activity from any website. So there's a lot of different places to get it. The snippet that I showed you guys is from a scanner called Trade Alert, and they're based out of New York. They have a monthly subscription fee. We also offer one called Option Hacker that is available on our website, which is one of the more lower cost choices out there. But if you don't want to pay for a scanner, there are built-in solutions in thinkorswim and TradeStation that you can use to scan for unusual options activity. And I'm not going to spend too much time on this because I want to be able to get through all my trading plan, but I'll show you really quickly. Here in thinkorswim, they have a, it's kind of similar to HeatSeeker. Here they have in thinkorswim a built-in search called Sizzle Index, and what the Sizzle Index does is it tells me all of the stocks that had unusual options activity today relative to the 5-day moving average that we have for usual volume. So when I see FBC with a Sizzle Index of 143, it means that it's traded 143 times its 5-day moving average of options volume. Now, looking at this today, that's probably going to be pretty skewed, right? Because what did we have over the past 5 days? Well, we had yesterday and 4 days of trading last week. So those 5 days are a pretty thinly traded time of the year for the equity options market. So a lot of stuff is going to have unusual volume if we compare it to a 5-day average. All right, but once I have this, I can look in time and sales and see what the individual orders are in thinkorswim. And I'm not super familiar with TradeStation, but I do believe that they have a similar scan function in there that kind of allows you to see the same type of information, right? Someone says, is this strictly for options trading, or can you also apply it to stock trading? Yes, you absolutely can apply it to stock trading, and I'm going to get to that in a little bit here. So what do we need to do to take advantage of the equity options order flow that we see coming across the tape in a given day? Well, I need to have a plan in place, right? There's a lot of information out there that I can glean from unusual options activity. If I'm just taking a look and trying to do an analysis and assess the entire block of order flow that would be considered unusual that comes across the tape in a day, I'd never get to the point where I actually make a trade. It's too much stuff to go over, right? So I need to figure out by using this plan whether or not the trade is a hedge or a speculative bet. There's two main participants in equity options trading, hedgers and speculators. Which one do I care the most about? Well, I care the most about the speculators. I want to know where institutional money is speculating on large moves in the underlying. All right, so what that means is that I need to completely throw out any trade that I think has the possibility of being a hedge, okay? Someone says, how do you know if the unusual order volume is a buy or a sell? It depends on where it traded at, and I'll show you in the Boeing example here, it's painfully obvious that it was a buy, and I'll show you how you can see that. So I need to make sure that probability is on my side. So I need to trade opening orders, I need to trade speculative bets, and I need a plan that helps me figure out when that is the case. And we have developed one. We call it the Oak Ribbit Trading Plan. Now, it's an acronym. I know that's probably not the most eloquent thing you've ever heard, but it does describe the different points of analysis that I need to do to make sure a trade is actually representing a good speculative bet for me. And it has me analyze order flow using these 7 different points to determine whether or not I actually want to take a trade with the unusual options activity trader that is doing the order, right? And we call it the Oak Ribbit Trading Plan because it stands for open interest, chart, risk, reward, break-even time, and target. And all of these things are going to help me determine whether or not I want to actually take the trade that just hit the tape. So let's go back to Boeing, okay? And someone asked me, how do you know if it's a buy or a sell? And before I even talk about open interest and how, what that means to us, I want to talk about that. So what we have here is an order that went down at 55 cents. Do we all see that? They bought these for 55 cents, or they traded for 55 cents. How do we know, and how does the system, how would Trade Alert, how would your thinkorswim platform, or how would TradeStation realize that this was a buy? How do they know that they weren't selling these? Well, we're able to determine that because we can see the market at the time of the trade, right? We can see that at the time of this trade, the market was 47 bid at 51 cents. Now, these traded for 55 cents. Is there any market maker in the world that would pay this trader 55 cents for these puts when their best offer in the world was 51 cents? No, they absolutely would not, right? That's never going to happen. So what we're able to see is that, hey, the best offer in the world was 51 cents when this trade went down. They paid 55 cents. So not only were they buyers of these puts, they were aggressive buyers of these puts. They aggressively bought these by paying through the market maker's offer and sweeping them off of multiple exchanges. They wanted to get as many of these as they could and were willing to pay up to do that. All right, now just because that is the case, just because I see someone coming in and aggressively buying puts, it doesn't mean that it is an opening position. It doesn't mean that it's a new initiating trade being put on by this trader. What they're doing in this case is opening because it's labeled as such, but that's not always going to be the case. So let's assume for 1 second here that this little tag that says opening was not here, and that I didn't know for sure whether or not this was an opening or closing position. Well, do I want to ever trade a closing position with institutional money? Absolutely not, right? I want to trade an entry with them. I don't want to get in when they're getting out. I want to get in when they get in and get out when they get out, just like I described in that Boeing example and just like they led us to do in that Boeing example. But I'm able to determine for sure with 100% certainty whether or not a trade is opening by looking at volume and open interest. And here we can see that volume and open interest are 3,735 and 575. Volume needs to be greater than open interest for a position to be considered opening. Okay, it has to be. Because think about this logically. If there's only 575 contracts here in open interest, couldn't possibly be buying 3,735 to close. There's not enough open interest there for them to close. Okay, so I want volume to be greater than open interest. If it's less than open interest and the order isn't explicitly labeled as opening, then I can't say with certainty that it is an opening position and I want to move on. I also want to have that volume number be as large as possible of a ratio over open interest because it shows a more significant and more noticeable trade coming across the tape. Okay, so after that, I have to determine whether or not an order is a speculative bet or a hedge. Now, in that particular Boeing example, they were buying those puts with only 1 day left to expiration. So the technical analysis kind of thesis goes out the window for a second because they only have 1 day left to expiry. But in general, what I'm doing is using the Ichimoku cloud to validate setups and identify trends in the underlying stocks. So if I am able to do that, I want my order flow to match up with what the cloud is telling me. And I'll show you guys what the Ichimoku cloud looks like right now. Here we have PMCS on the Ichimoku cloud. Don't pay attention to all the lines and stuff here, but the Ichimoku cloud is the shaded area that we have here. So simply put, if a trader is buying calls, I want to see the stock above this shaded area because it shows that it's trading in a bullish area. If they are buying puts, I want to see it trading below the cloud because it shows me that it's trading in a bearish area. Now, Mark's going to come on here in a little while and show you guys how you can use the Chaikin tools to kind of get an inside look at what's happening order flow wise in the equities market, and you can actually use that to validate these setups along with any other type of technical analysis method. I use power tools to do that, and it's something that is able to give me a whole lot of insight as to whether or not it's more likely that an order is a speculative bet or a hedge. But for the example of Boeing here, we're pretty much certain that this is not a hedge, right? Think about this logically. If a trader is coming in and buying $200,000 or north of $200,000 worth of options that expire tomorrow, do you think that it's more or less likely that they're hedging? Well, it's way less likely. Generally speaking, institutions aren't coming in and putting on 1 day hedges, right? They're coming in and putting on a hedge that goes a month out, 2 months out, 3 months out, a year out, right? So a 1 day bet pretty much always reads as a speculative play as long as there's no other catalyst. If they were doing that ahead of Boeing earnings, that would be a different story. So once we determine that Boeing isn't likely to be a hedge, I then need to make sure that it fits inside of my risk, reward, and break-even metrics. I will never risk more than 5% of my book in any one position, so I have to ask myself, can I take at least a 4 lot of these and stay inside of that 5% max risk level? Well, these things were 55 cents, so I could take a whole lot more than 4 and stay inside that 5% risk limit. And the reason I want to take 4 is because I want to take 4 profit targets and 4 exits on my way out. All right, I can use stop losses to help lower my risk. If it's a more expensive option, as a beginner trader, I can use a 20% stop. I can use more as an expert or intermediate trader to kind of cut down on the risk that I have in those positions at any given time. Okay, and the final thing that I need to understand is that time and target are extremely, extremely important when trading unusual options activity. In this Boeing example, what is the trader's price target? And any of you could probably figure this out. What is his price target? What is the level that he thinks is likely in Boeing? Well, he thinks that we're heading below 147 by tomorrow. He thinks it's happening by tomorrow. So what if I were to look at the options chain and say, okay, well, I can buy the same 147 puts that he did for 55 cents, or I can buy the 144 puts for 20 cents or 15 cents. And it's so much cheaper. I can buy 3.5 times more of them than I would if I chose the same option as the institutional trader. Well, that doesn't really work, does it? Because if I'm doing that, I'm basically flying in the face of all of the reasons why I think his order flow is meaningful to me. I know that they spent a whole lot of time and a whole lot of effort to choose that particular expiration and that particular strike price. And if I were to then come into the market and put on a trade of my own that was different than that, then I certainly am kind of discounting all of the things that I think are important about unusual options activity. So I want to trade the same strike and the same expiration. When trading unusual options activity for the first time, this is where 90% of retail traders mess up and kind of go awry of the plan, is when they think that they can trade different expirations or different strike prices for less money, and then it doesn't happen to work out. And think about it like this too. You know, the Boeing trader, that was pretty clearly a trade done with insider information, as was PMCS. If I think that that's a likelihood or a possibility, why would I want to trade anything different than what they're doing, right? They spent a lot of time to pick which contract was going to give them the best percentage return on their invested capital given their thesis. And let's say that his thesis was, I don't have a thesis. I know that we're getting downgraded tomorrow in Boeing. He sat there and figured out which ones were going to give him the best return and chose those. I want to choose the same ones. So I think I only have about another 15 minutes or so here, so I want to leave that time for questions. But before I do, I want to tell you guys a little bit about what some of our customers have had to say about trading unusual options activity. Charlie said, I want to take this opportunity to thank you for sharing your trading experience. Having just joined the trading room a couple of weeks ago, I made $27,000 in craft this morning thanks to the unusual options activity trading plan you taught me. For those of you that remember the Kraft-Heinz merger, that one was signaled 2 weeks in advance of the announcement by massive unusual options activity. Matt said, as a new options trader, I lucked in a seminar about unusual options activity in August. My first week generated over $1,000 in profit, and just yesterday, one trade delivered over $2,000 in profit. Steve said, it helps to stay in a trade and maximize profits, helps on reversals, and this is just my first day. Wish I had this 29 years ago. I recommend this to everyone. Great job. Your team deserves a kudos. So, what I want to offer you guys now is a chance to learn a little bit more about unusual options activity and then apply it using your own trading ideas. So we're offering you today our unusual options activity trading plan workshop. It's on demand, so as soon as you make your purchase, this is automatically sent to you. You can start going through it. It's actually about 8 hours worth of seminar and supplemental material, but what we're going to talk about in this workshop is putting probability on your side and getting trades from hedge funds, what to look for to differentiate between speculative options orders and those placed against a hedge, the most concrete unusual options activity course ever created with 13 years of profitability backing it up, a complete guide to all things unusual option activity, and a 1-month bonus subscription to our gold package. And this is where you're going to get both of our ebooks, hundreds of hours of members-only videos archived on our website, access to our members-only webinar series and discounted workshops, twice daily email alerts, and all of our head trader Andrew Keen's entries and exits via SMS text messages in real time. So some of you are asking where you can get this order flow information from. Well, by signing up for this for only $99. And if you go to our website, the course itself is $497. For 99 bucks, you can get the workshop that you need to learn everything you need to know about unusual option activity, and then access to the trades that we are placing based on unusual option activity in real time as they are happening. So I'm going to put the link in here for you guys. I wanted to do this early so I can have more than enough time to go over questions with you guys. So the link here is alphashark.com/Chaikin. So you can go to that, fill that out. For 99 bucks, you get access to this workshop and to 1 month of our gold package trade alerts. We actually have never bundled these two things together. It's actually a pretty natural kind of package because it gives you the workshop and the tools to kind of understand what's happening with unusual options activity, and then gives you the orders and alerts via the SMS text messages, the twice daily emails, and our members only webinar series where you can come, now I believe we have it 3 times a week, and ask as many questions as you want. So someone said, hi, what is a sweep? So the sweep designation that you saw on one of those orders before tells me that the order was filled on multiple exchanges and that the trader had to sweep all of the available offers across all of the exchanges to get their order filled. It shows a more aggressive type of trade entry. Is this a workshop or a live event? So the workshop itself is on demand. You're sent a link with access to all of the videos that are part of the workshop, and you have access to that forever. You never lose access to it. The gold subscription is something that you subscribe to and you have for 1 month as part of this deal, and you get your get all the trades that we take sent to you via SMS text messages in real time. Is the Option Hacker tool included in that? No, we do not include Option Hacker in this. I do believe that you might be given an opportunity to try it if you take this offer for an additional subscription fee, but I'm not 100% sure. What we have here is the workshop, the basics for how to learn to use this information to your advantage, and then we give you the information via our gold package that you're getting a 1-month trial to as part of this. We've actually never package these two things together, but like I say, for all of the workshops and presentations that we do, if you try this out, you go through the workshop, you try the trade alerts out for a week, you decide you don't like it, or it's not for you, it's not something that you can apply to your trading plan personally, then we are more than happy to issue a refund. We have a 100% satisfaction guarantee with all of our products. So if that is the case, we do not want your $99 and we will give you your money back. What happens after the trial month? After the trial month of the gold subscription, it does automatically renew at 99 bucks a month. If you go to our website right now, it's $169 a month. So it actually renews at a pretty significant discount from our regular price. If you don't want to renew, you can tell us tomorrow if you want that you don't want to take it after the 1 month, and we will make sure that you are canceled. You are under no obligation whatsoever to continue with your gold subscription after going through this workshop and trying it out for a month. So any other questions, guys? Any other questions? Go over how to set up the scan in thinkorswim one more time. Sure. So it's not really something to set up, and I could very easily probably talk about this for 2 hours if I wanted to. So I'm just going to kind of give you the broad strokes again here, and I'll leave the link there in case any of you are interested in trying this out. So they have a built-in scan function that'll give you a specific scan for unusual option activity. And it's right here, the sizzle index. You press that, and it brings up these metrics that they have in here. Now, I, for one, don't really like to trade stocks that are under 10 bucks. I want something that's going to be a little bit more liquid than that. So maybe I change these around a little bit, and I can see that it is starting to narrow the amount of stocks that I'm looking at any given time. Now, what you can do with this that's really kind of interesting is you can get really, really granular in your filtering metrics in thinkorswim. That's definitely one of the cooler parts about this scanner that they have built into this. You can search for sizzles, meaning unusual option activity, based on all options volume, put options volume, or call options volume. And then you can go ahead and get even more granular than that. So let's say that I want to know what oil stocks out there had bearish put activity more than 2 times its average daily volume. I can easily set that up. I go here, I say select all energy, I have my filters here. I want to see anything that has 2 times um, average daily bearish options volume, or at least put buying or put trading, and then I get the list here, and then I can go into time and sales and see all of the individual orders in these. So I can get really, really granular. I can say, wow, a crude oil had a big slide today. Where were they coming in and pressing shorts in oil names in the equity options market using puts? And I can figure that out. On average, how many trade alerts are sent out daily or weekly? That's a pretty tough question to answer. It all depends on order flow in the market. Last week is a good example of one where we didn't really have very many. We were probably only tracking maybe 3 or 4 orders that even were worth running through that trading plan per day. Today, we probably tracked like 20. Out of all of those 20, we took 2 trades. So it really kind of depends. When it's a holiday week, order flow is slower. When we're going into a big catalyst event like the Fed, order flow can lighten up a little bit. No one's taking any really huge positions. It's all driven by the institutional traders out there. So if they're trading, there's a lot of order flow. If they're not trading, there's less. But what's really great about unusual options activity is that hedge funds are never just going to stop trading one day out of the blue, right? Unless they blow out or go out of business, there's always going to be an institutional trader out there that has risk capital to put into the market. So that means that there's always going to be some type of order flow generated. Confirm to get lifetime access to the webinar. How long is it? Ebook, how many? So the workshop itself is about 2.5 hours long, and then it comes with a bunch of supplemental materials. So after you watch the 2.5 hour long workshop, there is a collection of videos that come with it that describe unusual option activity as it's happening in real time. So it's videos and recordings of the market hours taking place in real time, and someone breaking down, our head trader breaking down order flow in real time. So you can kind of see how you then apply what's talked about in the workshop to actual trading during the day. The ebooks, you get both of our ebooks. You get access to those forever, and there is hundreds, if not thousands, of hours of more educational material on our members-only section of the website. What is it that is alerted twice a day? So you get all of the entries and exits in real time, and then twice a day you're sent an email summary of all of the day's activity. Once in the morning before the afternoon session, and then again at the end of the day. That kind of wraps up all of the stuff that has come across and that we've traded during the day. Someone says, sometimes I see a large amount of puts at a certain strike, but at that same time, there's a huge amount of calls on the same strike. What is going on? That is a great question, and that is kind of the mystery of unusual option activity. If you don't have a super good knowledge of options, it can be kind of difficult to read what is happening at any given time when you see something like that. And we talk about this a lot in the workshop, looking at order flow and determining what their actual motivations are. When that happens, when someone comes in and buys puts and sells calls, or sells calls and buys puts, what they're doing is actually putting on a synthetic stock position, or they might be putting on a collar. And that is something that replicates this profit and loss profile of a long or short stock position using equity options. And generally speaking, that type of order flow isn't really actionable because, and this is going to get kind of technically heavy for 1 second, because what they might be doing is getting long stock in the stock market and then coming into the options market and getting short stock synthetically to try to profit off of a spread or an arbitrage opportunity that was there for a half a second. Does that make sense, Diane? Yeah. So they might be doing the exact opposite. They could be coming in and putting on a position where they are selling stock in the equities market and getting long synthetic stock in the options market. Those are called reversal conversions, and they happen a whole lot around dividends and around M&A, post M&A announcements. Right? Whenever you see a stock gap up to, $1 below the price that it is to be acquired at, that's when those guys jump in and start doing their reversal conversions, and you see a lot of activity like that. Yes, these are entries and exits that Alpha Shark is trading. So you get to see all of the trades that we are putting on in a given day. Yes, we talk. If you have access to the scanner and Thinkorswim, you can use all of the stuff that we talk about in the workshop to find the order flow and then glean the information that you need off of it. Ba, ba, ba. What are my thoughts on XPO, a 13,450 lot traded today on the Jan 24 put line? That is a good question. So XPO, and this is a lot of what we talk about in the workshop, right? XPO is is a stock that trades around 26 bucks. But what we want to look at here, someone says that there was a lot of options traded on the Jan 24 put line. Well, the first thing that I want to understand is how much stock does XPO trade in a day? It doesn't trade very much, right? It trades about 784,000 shares a day. That's not that much stock. So I know that a 14,000 lot is probably pretty significant in terms of options order flow. But what I'm able to see here is that if we take a look at, and let me see if I can pop out options time and sales here. If we take a look at the way that these actually traded today, and here we have the order flow. Here's the trade, right? Here's the big trade that drove most of the volume that we see on that line right now. They traded the 24 strike puts for 35 cents when the market was 30 bid at 60. So looking at that right now, what do you think they did? Do you think they bought those or do you think they sold those? The market was 30 bid at 60 and they traded for 35, right? These were probably closing. Or I'm sorry, these were sold. These were labeled opening, but these were sold. They sold these puts. So that completely changes the thesis that you might have developed by seeing that, knowing that they sold these, because now that we know that they were short puts, what does that tell us? It tells us, no, this trader doesn't think that the stock is going below 24. They think the stock is going to stay above 24, and they're drawing a line in the sand here in XPO saying, hey, we think that we're going to stay above 24, so we're going to sell the 24 strike puts in January, right? And they have this view for at least over the next 10 days, right? Because these options expire in 10 days. So they might be saying, hey, there's a really high chance that XPO stays above $24 through the next 10 days. Try to collect 35 cents or $35 per one lot if we're right about that. After purchase for $99, that is after the 30 days. Yeah, so the gold subscription renews after 30 days. Yes, it's a 1-month trial. So any other questions here, guys? Any other questions? I know we started about 5 minutes late, but I don't want to run into Mark's time at all. So any other questions? I'm going to put the link in here again for you guys, alphashark.com/Chaikin, and you can use this to get access to this deal. I think this is probably one of the better promotions we've put together in a long time because it gives you kind of all the tools in one basket, the educational stuff that you need to kind of understand what's happening with unusual options activity, and then a little bit of hand-holding through your first month of trading unusual options activity. So any other questions, guys? Any other questions at all? Any other questions? Is there? Is there what? Any other questions? Probably have time to take like 2 or 3 more. Oh, so yes, I'm sorry, I completely forgot to mention that. So generally speaking, because we are options traders, we use unusual options activity to place options trades. But it's something that can be applied to anyone who's trading anything. If you're trading stock, you can still use this information to kind of glean what it is the market participants are thinking about as they're putting on these trades. So if I see a huge block of Boeing puts being bought with expiration tomorrow, and I don't see them sell them at the end of the day today, what happens when I come in tomorrow? Well, I'm going to be looking for short setups in Boeing stock if I'm a stock trader, right? So that's what's one of the better things about trading this way and looking for this type of information is that no matter what kind of trader you consider yourself to be, meaning if you're a day trader, a swing trader, a long-term investor, an options trader, a stock trader, the information that you get from unusual options activities applies to all of you, right? And what's great about it is that hedge funds and institutional traders, they trade over all of those holding periods, right? They trade for positions that expire tomorrow. They trade for positions that expire next week, next month, 3 months, 6 months, 9 months, 2 years. So I can look for the order flow that makes the most sense for my trading style and my preferred holding period, and then I can use that information to make smarter choices. Are your entries and exits given as a stock price or options price or both? So when we're trading stock, we give it as a stock price. When we're trading options, we give it as an options price. Do the stocks you choose often go with what is seasonal? Not necessarily, not necessarily. So I think that, I'm going to put the link in here one more time, but I think that pretty much brings us to the end of my time here. So I'm going to go ahead and turn it over here. So Mark is going to come on and talk to you guys about the Power Tool Suite, and it's something that I use in conjunction with a lot of our other trading plans as well. It's something that kind of can lift the hood up in the stock market and show me what's going on in terms of money flow, buying and selling pressure at different points, and it really kind of gives me a really nice look at what the options trader's motivations might be based on the positioning of the overall stock market, right? If I see puts that were bought in a position and I'm able to take a look at the money flow indicator and see that money has just been pouring out of a stock, well, then I'm pretty much able to make the determination right away that it is not a hedge, right? That it is not a hedge. They are speculating. Likewise, if I see puts being bought in a stock and money flow has been incredibly strong into the name, then I'm able to determine pretty quickly that, hey, it probably is a hedge. People have been picking up the stock like crazy. Why would they be buying puts to get short now? Right, so it's a fantastic tool set, and I am happy that this is the first time we've kind of done a joint webinar like this. I think the two topics flow into each other really, really well. So I think that you're going to kind of be able to use both to get some really interesting insights here. So enough from me. I have the link in here for you guys here, alphashark.com/Chaikin. Before I turn it over here, I do just want to give you guys my email address as well, james@alphashark.com. And if you have any questions about the offer we just talked about or anything we went over, please feel free to shoot me an email. Typically speaking, I'm able to get back to you within 24 hours, sometimes quicker. So please, and without further ado, I'm going to turn it over to Mark Chaikin.
James, thank you very much. I'll just do a sound check. If you can hear me, type Y into the question box. We literally went through a fire drill to get this webinar up and running. The new office building that we moved into on December 7th had a false alarm, and we walked down 18 flights. And thank you to Joe Bacella, who regrouped at his brother's apartment to make this possible, and I'm now in the warm confines of my home. So I'd like to thank James Romelli. I think you know from his presentation that this is valuable information. What I gleaned from the Q&A is that James, as I knew already, is a really savvy options trader. And what I know from clients of Chaikin who've subscribed to the Alpha Shark trading room and the various services is that they've made a lot of money trading off James's ideas in the trading room. So I want to thank him and all the Alpha Shark people who are on the webinar today. This is a great presentation, James, and we really appreciate your sharing this knowledge. Now, what I'm going to do in today's presentation is talk about my checklist for finding winning stocks and avoiding losers, and this is particularly important in 2016. So we're going to spend a little time in the beginning of the webinar looking at what the stock market is facing in 2016 and how we're positioned technically. And I think the couple of days have sort of shaken the confidence of some people, and I don't think you should really be particularly concerned about what's gone on the last couple of days because it's keyed to an exogenous event, something in China and perhaps Iran and Saudi Arabia that we can really point to. If it was triggered by unknown forces, that would be of some concern to me. And that's why my background is so important. I've been on Wall Street for 50 years. I've lived through 10 bear markets. And for 45 years, I've been using technical analysis in addition to fundamental factors to help drive my investment and trading decisions. Along the way, I've been mentored by some of the smartest and most successful institutional investors, and the reason that's important is because the Chaikin Power Gauge rating, which is at the centerpiece of everything we do at Chaikin Analytics, is the culmination of my life's work, and it was vastly influenced by my clients who are fundamentally driven institutional investors. Everybody from Fidelity to T. Rowe Price to Soros and Steinhardt hedge funds in the old days and the Paulson hedge fund today. And it's really important because at the end of the day, fundamentals are not enough. So I've been with a number of very, very fine firms on Wall Street. I started with Shearson Hamel, and I got registered as a stockbroker the day the bear market of 1966 ended. So for the first 2.5 years, because Shearson had such a great fundamental research department, every day was an uptick. And then in early 1969, the first bear market I had ever experienced reared its ugly head, and I pretty quickly realized that fundamental research wasn't enough to invest and trade profitably in a bear market. You needed technical analysis as a reality check. So when I went to Tucker Anthony, which was a great regional firm, to head up their options department, I pioneered the use of technical analysis in options trading, because in both stock and options trading, you need an edge. Now, AlphaShark gives you an edge because they analyze unusual options activity. Chaikin Analytics gives you an edge because we do the heavy lifting for you on a fundamental basis. The Chaikin Power Gauge rating, which is 85% fundamental, tells you the probability that a stock is likely to outperform or underperform the market. And in the live Q&A, we'll take a look at PCMS or PMCS and show you how the power gauge had turned bullish, meaning the fundamental factors had lined up positively just before AlphaShark and James spotted that unusual call buying. But at Tucker Anthony, I really learned that to be a successful options trader, you do need an edge, and for our clients, that edge was my technical research. Then I moved on to Drexel Burnham, which is sort of infamous because of Mike Milken's junk bond shenanigans. But I was blessed because at Drexel I worked with George Douglas, who had the best quantitative database on Wall Street. And that's where I started bringing together fundamentals, technicals, and quantitative factors. And that's part of the genesis of the Chaikin Power Gauge rating. Now, there's an interesting thread that weaves through all of this. All three of these firms were preeminent when I joined them. Not one of them exists today. But fortunately, I'm still here, quoted in Barron's and Forbes, on CNBC, was just on Fox Business 2 weeks ago. So why is that the case? Because I've developed what I call a reality-based approach to the stock market and investing and trading. And that means combining fundamentals with technicals to get the full picture. But don't believe for a second that just because someone is on CNBC or Fox Business that you should follow them blindly. Here's Jim Cramer, who as we speak is going to be, or at 6 o'clock is going to be talking about Chaikin Money Flow with one of our great friends, Bob Lang, who's going to be on there as a technical analyst tonight. But even Jim Cramer gets it wrong occasionally. And back in October, when La Quinta gapped down dramatically, Jim Cramer finally threw in the towel. He had been very bullish on La Quinta, and he said, now look, I got La Quinta wrong. Mea culpa. I should have been more skeptical and less willing to believe the CEO's exuberant bullishness. And you could have replaced bullishness with a more graphic word, because the CEO was conning people. He was telling everybody that everything was great, but this Chaikin chart from our iPad app tells a totally different story. Sell signals, which we're going to explain in the webinar, our unique relative strength indicator went bearish in July. Now, this is a stock that was taken public by a private equity firm April a year ago. In 2014, so we didn't get a power gauge rating for a year because we need that data. But it was immediately bearish, which meant that this stock was overvalued. And the combination of a bearish power gauge rating and negative Chaikin money flow, which measures the institutional buying and selling, as James said, combined with sell signals, should have encouraged the Jim Cramers of the world to think twice about recommending the stock. And so don't blindly follow people on television, whether it's Mark Chaikin, Jim Cramer, or some of the less respectable gurus who they get on there. Now, in the next 45 minutes, I'm going to help you prepare yourself for 2016. We're going to go through my checklist for finding winners and avoiding losers. It's going to be particularly important in 2016 because the market's going to become much more volatile. It's going to be a market of stocks. In some sense, 2015 was a market of stocks. Energy went in one direction. Some of the big cap names that they affectionately called the FANGs, Facebook, Amazon, Netflix, and Google, did extremely well. But 2016 is a year that you really have to be sharp. But let's look back for a second at 2015. What were the big drivers that moved the market in 2015? Well, it was the economy. The economy was weak in China, it was weak in Europe, it was strong here in the United States. Sort of a steady Eddie, slow growth economy that the world liked. The price of energy was a huge driver. Obviously affected a lot of the commodities and oil related stocks, with the exception of the refiners. And we'll show you how Chaikin sort of found the refiners because the fundamentals were so bullish. China was a big factor in 2015, and we saw on Monday that China is going to be a big factor in 2016. And obviously the Fed and Janet Yellen, with that first interest rate hike in December, played a big part as people were debating endlessly on CNBC about whether or not they'd raise rates, when they would raise them, what it would mean, and so forth. And all of that means that there's volatility ahead in 2016. So let's look back a bit and see what the technical status of the market is heading into 2016. I'd like to start with a 5-year chart of the S&P 500 ETF, the SPDR, the most actively traded instrument on the U.S. markets. And we've got a 5-year chart here, weekly data. And what we see is that after the W bottom in 2011, and a W bottom is just what it sounds like. You make a low on panic selling, you rally up, retracement, come back and test the low. You either make a lower low or equal, slightly do better than the previous low. And then if all is well and you're not in a bear market, and we clearly weren't in 2011, you start moving up. Now for 4 years after that W bottom in 2011, in October, amazing how many of these bottoms come in September and October, almost every decline was in the form of the letter V. Now what that meant was buy the dips made it pretty easy to make money if you believed in the stock market. So we had 4 pretty good years from 2011 to April of 2015 where you could buy the dips. So V-shaped bottoms were an opportunity. And interestingly, every one of those V-shaped bottoms was a decline of between 5 and 10%. When declines exceed 10%, as they did in 2011 and as they did in August and September of 2015, they typically require more time and therefore a W-shaped bottom in order to get going again on the upside. So we come into 2016 having made a W bottom in September of 2015 at roughly the 1867 level on the S&P cash index. And what are we looking at now? Well, here's a 1-year chart of the S&P. And a couple of important points on this chart. Number one, in this April-June time framework, when the market had trouble getting through 2100, 2130 on the S&P, Chaikin money flow was really your friend. Chaikin money flow looks back over 21 days, measures institutional buying and selling in the main. The reason I say that with confidence is, A, I created this indicator over 35 years ago, and it's in every package, Thinkorswim, TradeStation, Options House, Schwab, whatever, on Bloomberg and Reuters. And it's done an effective job of measuring money flow into stocks, but it also does a great job of measuring money flow into ETFs. So when the market was having trouble moving beyond 2130, look at what was going on with Chaikin money flow. Whereas earlier in the year, there was huge money flow, and yet again we saw that off the September bottom, not off the August bottom. When Chaikin money flow is negative, as a major market index like the Spider is trying to get through, apologize for that, touchy mouse, that's a bearish indication. So now let's fast forward to the W bottom that we saw in August, September of 15. Panic selling based on Chinese devaluation of the yuan. I actually think it goes back a week before that to the Disney earnings, which undercut the strongest stock in the consumer discretionary group, and a lot of panic selling in the markets, fear of an interest rate hike and so forth. Money flow on this interim rally, which was a pretty big retracement. For those of you who follow Fibonacci, that was a 62% retracement of the decline. Money flow stayed negative. Again, a warning sign that there was going to be a W bottom. But look what happened coming off the bottom. Now in the S&P cash, the low was exactly equal to the previous low. Because we had that panic on August 24th, that what I call market order Monday, you got some very distorted prices in ETFs, and we learned that you can't put in market orders when you know the futures are down 100 points, 1,000 points in the case of the Dow pre-opening. Coming off that September bottom, within the volatility bands, you picked up enormous money flow. There was big buying that was chasing that rally. But since that peak that we made above 2100, we have yet again run into resistance, and we've made a series of lower highs and lower lows. So on a short-term basis, coming into 2016, we were a bit vulnerable. But because the last 2 days of 2016 had been down, 15 had been down, the expectation was that we'd get a 3-day rally to begin the year, which is very typical. But look at the money flow. The money flow was saying that rally may be an opportunity to sell. And in our weekly market letter this Sunday, we said, expect a rally, but be prepared to sell into it. Well, China threw a monkey wrench into those plans. Some negative economic news. They announced that they were going to allow insiders to start selling their stock again. They had banned that in July. That was part of the reason that we had the August decline. And they halted trading. That makes the market nervous. Combine that with Iran and Saudi Arabia butting heads, and you had a prescription for a big, big drop. But it wasn't as bad as August 24th. One other thing that I'll point out here, which we've been stressing, my colleague John Schlitz, who writes our morning market commentary, and I have both been stressing this. We have something called the power bar, the Chaikin power bar. It tells you how many stocks in an ETF, an industry group, a market average, a list, have bullish versus bearish power gauge ratings. Now, for the last 8 months, since April, there have been more bearish than bullish stocks in the S&P 500. And that's been true in the NASDAQ, and it's now true in the small cap stocks. And we're going to see another chart of the equal weighted S&P. Now, first of all, I'd like to ask you, how many of you trade options on ETFs and indexes? If you do, please type Y in the chat box. And I see that a lot of you trade index options. Well, if you do trade index options, Chaikin Analytics is your friend, because you see the Chaikin money flow, you see the power bar for the index, and we have these relative strength buy and sell signals that have proven extremely effective for short-term options trading. So this is the backdrop for the S&P 500 heading into 2016. Now, there's a debate going on about whether small caps are going to start outperforming the market. Since mid-July, small caps have been underperforming the market. How do we know that? Because we have a unique relative strength index that compares any tradable to the S&P 500. In this case, we're comparing the IWM Russell iShares 2000 small cap index to the S&P, and you can see that it went from outperforming to underperforming. And this is really annoying. I'm sorry about that. I'm going to leave the mouse alone. We made the same W bottom in the small cap, except we made a lower low, picked up some money flow coming out of it, but it was a weak rally. And in this Sunday's Market Insights, I suggested that if we were to rally up another 1.5 to 3%, that a bearish position in IWM would have been appropriate. We'll see that toward the end of the presentation, but here again, the power bar is weak for the small caps, 262 bullish versus 395 bearish. And we've actually almost fulfilled our downside projections of 106, 108 on yesterday's decline. So the opportunity was really not there to put on that position, but because the money flow was weak, this was my bearish stock of the week. Now, looking ahead to 2016, what's going to move the market? Obviously, future interest rate hikes have been indicated by the Fed. How many and how frequently is going to create volatility, because we're now in a situation where every Fed meeting, and they come roughly 6 weeks apart, is going to create speculation. Talking heads on CNBC are going to be angsting over this. Hedge funds are going to take positions based on it. It's going to increase volatility. Commodity prices will have a big influence in 2016. No indication yet that energy has bottomed out. Steel, another commodity, has been a disaster. And so the trend of commodity prices is going to influence the stock market. Whether or not the dollar is strong or weak is going to have a big influence on the market. A strong dollar has been headwinds for big companies like Caterpillar and IBM. Right now, the dollar is not quite as strong as it's been. And probably a mildly toppy or weak dollar would be a plus for the stock market. Excuse me. Fighting off a long 3-week cold. Breadth divergences, which we're going to look at in a minute, are going to be a big determinant for how the market moves in 16. And then strong and weak sectors are so critical to knowing where to put your money. Now, what do we mean by breadth divergences? Most people talk about new highs, new lows, advancing versus declining issues. At Chaikin, we look at that power bar. If you make a new high in the S&P, you want to see more bullish than bearish stocks. That has not been the case. But first, before we look at that, let's look at what happens typically after a rate hike. John Schlitz put together a series of charts using the Bloomberg terminal to show you what happens after the first rate hike in a cycle. And it's fairly consistent. This is 1994. As you can see to the left of the white line, the Fed funds rate was 3%, down from 9.5% in 1989. And then the Fed started raising rates. And as soon as they started raising rates, we had a 7.6% decline over about a 4-week period. Then the market started moving up again. And even as rates were rising from 3 to 6%, the stock market rallied sharply. So don't believe the people on television who tell you that the market's going to go down if rates go up. The first 3 rate hikes typically are associated with a rising market. Why? Because it means the economy is strong enough that the Fed thinks they should be raising rates. So we're now at full employment at 5%. Our economy is still growing, whereas Europe and China have some problems. So once we get through this sort of flack that we're experiencing, should see a market that's moving higher. Do we think the market's going to be up sharply in 2016? Probably not. But don't expect a bear market. And the reason I say that is bear markets are usually associated with recessions. There's no indication that a recession is on the horizon. Recessions are normally associated with what's known as an inverted yield curve. An inverted yield curve is very simple. It means that short-term rates are higher than long-term rates. Well, even if the Fed raises 3 or 4 times to 125 to 150 level, I guarantee you that long-term rates are not going to drop below that. They're right now at 2.25 to 230 on the 10-year note. So no inverted yield curve, no signs of a recession, unlikely to get a bear market. But there are some headwinds. So 2016, as I said, is going to be a year of living dangerously. It's going to be a year when stock picking is going to be very critical. And one of the things that I look at, and this is the first time we've ever exposed this on a webinar, is the RSP ETF. This is the Guggenheim Equal Weighted S&P 500 ETF. It's been around since 2002, and up until 2015, it had outperformed the SPDR by 200 basis points a year. That means if the SPDR was up 10%, the Guggenheim was typically up 12%. But look what's happened. Since March, April of 2015, the equal weighted S&P ETF, the RSP, has been underperforming the SPDR. What does that mean? It means that the large cap stocks like Google and Amazon and Netflix and Facebook have been driving the market, but under the cover of strength in those big stocks, the other 450 smaller cap names in the S&P 500 have not been doing well. And typically in that environment, the market doesn't do well either. So we just had a relative strength sell signal in that Guggenheim equal weighted ETF. How do we get that? It rallies above its 21-day exponential average and drops back below it when it is in the red in terms of relative strength. So it's a fairly simple indicator, but it's very powerful. Now, you see that there were 2 relative strength buy signals early in 15 and 3 relative strength sell signals in the summer of 15 ahead of the August flash crash. Again, just like with the SPDR, picked up money flow on the rally. Not quite as negative in terms of money flow here. Some people are betting that the small caps in the S&P, the smaller caps, because this is a large cap index, will outperform. So we're going to monitor this equal weighted S&P. Ideally, for the market to get going on the upside, we'd like the other 400 stocks in the S&P 500 to start doing better and outperforming the larger cap stocks like Google, Amazon, Netflix, and Apple, Facebook. If we see that, we'll alert you to it. But you can do this on your own. Just look at the RSP versus the SPY. If it starts to outperform, that's a sign that the market is healthy and likely to do better. So having put us into a perspective that says that stock picking is going to be very important in 2016, let's delve into the Chaikin analytics methodology. Very important, as James said, to have a plan, whether you're trading options or stocks. For us, the plan, the centerpiece of everything we do is the Chaikin Power Gauge rating. Fundamentally based predictor of whether a stock's likely to outperform or underperform the market. Also very important in 2016 to monitor sector and industry group trends, and we'll see why in a minute. At the bottom of the pyramid are 2 technical indicators, Chaikin money flow and Chaikin relative strength, that work very, very well with the Power Gauge rating, our fundamental go-to guide. And right in the middle, buy and sell signals. Because if you're an options trader particularly, selling and buying at the right time is so critical. It's also important for swing traders and for investors because there's nothing that shakes your confidence more than to buy a stock and watch it go down 10%. So this is the complete package, and it's the Chaikin methodology, and we're going to walk you through the steps on how to apply it. Starts with the Power Gauge rating, a very simple display. Looks like the gas gauge on your car. But please don't confuse simple with simplistic because this is a very powerful fundamental indicator. I like to say on these webinars that the power gauge rating is like a Chevrolet with a Ferrari engine under the hood. And the reason I say that with confidence is that this is a 20-factor quantitative model. It's based on working with successful institutional investors over a 30-year period, teaching them how to use technical analysis as part of their daily decision-making routine. In order to do that effectively, and we did it quite well because we sold our previous company to Reuters, I had to learn what they were looking at to make their fundamental decisions. And make no bones about it, whether they're using the fundamentals to buy big options positions or whether they're using it to establish big stock positions, the market is driven by fundamentals. So I distilled 200 factors down in a one-year research project to 20 and grouped them into 4 components. The financials are what a Warren Buffett looks at. Price to sales ratio, really important. If you pay too much for a dollar of revenue, you're on shaky footing. I like to say you're on a high wire without a safety net. Warren Buffett also likes free cash flow. Why? Because you can use accounting tricks to make your earnings look better, but you can't use accounting tricks to create actual cash. So free cash flow is a metric that a Warren Buffett looks at. And those 2 indicators are critical to the bedrock of the power gauge rating. Earnings, 5 indicators that a Jim Cramer would look at. Loves earnings surprise. Positive or negative earnings surprises, which lead to earnings estimate revisions, which are in the expert opinion section, and changes in analyst ratings. Technicals are only 15% of the model, but they're all proprietary. And the end result is an eclectic model that does the heavy lifting for you, because none of us have the time being our most precious commodity, to do this kind of fundamental research, even if we knew what we were doing. And before I created this model, I couldn't have done that research. But it takes time. Someone told us when we rolled out this product in 2013, I used to spend 2 or 3 hours researching a stock on Yahoo Finance or FinViz or Google Finance, and now you do it for me. And that's really powerful. So let's look at some proof points to see whether or not the power gauge rating is for you. And the first proof point is the performance of the power gauge rating life to date. We're going to update this through the end of the year, but this is both the simulated results and the real-time results since the model was first introduced in January of 2011. So we've had 5 years of real-time performance. On the right, the very bullish stocks in the Russell 3000, which is our core universe, were up an average of 21% annualized over this 16-year period. The very bearish stocks, on the other hand, were flat. And this was in a period when the market was up 7%. It's that spread between the very bullish and the very bearish stocks that gives you an edge if you follow the Chaikin methodology. Avoid the losers, focus on the very bullish stocks, and you'll immediately improve your trading and your investment performance. Now, the second proof point is real time. On April 14th, after NASDAQ had done a very thorough due diligence over a 5-month period on the Chaikin power gauge rating, they asked us to create 3 co-branded NASDAQ Chaikin indexes, starting with their large cap, small cap, and dividend achiever index. In the 21 months since we've gone live, all 3 of the NASDAQ Chaikin indexes have outperformed their underlying benchmarks. But there was a big condition that NASDAQ put on this. They said, you can't change your index but once every 12 months because we only rebalance our index every 12 months. So these were basically buy and hold indexes, which makes it a lot more difficult. Imagine trying to pick a stock that you're going to have to hold for 12 months. Well, the large cap index outperformed by 269 basis points. The small cap index, in a period when small caps were down, which has about 225 stocks in it, roughly 15% of the master NASDAQ 1500, beat the benchmark by 800 basis points and the dividend achiever by almost 700. So all 3 of the indexes in the 21 months since they've been in existence, and you can quote these on Google Finance or Reuters or Yahoo Finance, CNBC, have outperformed their benchmarks. Why is this important? Because we've said on these webinars up until we launched these indexes that the Chaikin Power Gauge rating had predictive value 3 to 6 months out, which meant it was great for swing traders or options traders, because a stock that's going to outperform the market over the next 3 to 6 months is likely to be a good performer on a short-term rally. You don't get from 0 to 100 in a split second. You get there over a 6-month period, and now we can say with confidence that the Chaikin Power Gauge rating has predictive value even further out. The proof being these indexes, which have to be static for 12 months. So unmanaged benchmarks that outperform the market. We've actually seen First Trust, who is a very, very big originator of ETFs and unit investment trusts, launch the Chaikin Low Beta Growth Index based on the S&P 500 on December 7th, and that index is now outperforming the S&P by over 120 basis points, and we all know what the market has done since early December. So lots of proof points to encourage you to believe in the power gauge rating, and that's the whole point here. I'm not tooting my own horn. For you to get maximum value out of what I'm going to teach you on this webinar, you've got to believe in the power gauge rating as a go-to tool that gives you an edge. Here's a chart of that NASDAQ Chaikin Power US Small Cap Index from Google. The blue line is the Chaikin Index, up 5.4% since April 10th of 14, whereas the NASDAQ index itself was down 180. What's even more interesting to me is we rebalance this on April 1st of 15, and I show you the power bar for those 215 stocks. Notice that in the 9 months since April 1st, when we rebalance this index, only 4 of the 215 stocks have turned bearish. That's extraordinary, because in a large cap or a small cap index now, you have more bearish than bullish stocks. In the NASDAQ Chaikin Small Cap Index, 38 bullish stocks, 4 bearish stocks. Shows you the staying power of what you're now going to see. So here's my checklist. First of all, use the power gauge to find winners and losers. Now here are the winners and losers that we identified in 2015, and the power gauge rating got you on the right side of all of these stocks early enough that you could have made big money. And at the bottom, the bearish stocks. So on top, there are some stocks that are still bullish, like First Solar, which Goldman Sachs recommended just 2 days ago. Activision, which is having a little bit of a profit-taking spell here. They just announced a nice acquisition that'll get them into the sports gaming business. Google, which is a premier stock, I believe, for 2016, and Barron's said the same thing over the weekend. Nike, which is consolidating, has actually turned bearish, but those are the stocks that outperform the market, the large cap stocks. Underneath, the losers, mostly in the energy sector. We're going to look at a couple of them as we move into the examples. And Wynn Resorts, which is having a little bit of a rebound rally because a couple of people have recommended it, but be very skeptical because they've been recommending a bounce in Wynn from 120 all the way down to 58. So be skeptical. Wait till that power gauge confirms it. So here's my checklist. Power gauge rating is bullish. Stocks outperforming the market. Chaikin money flow is strong, indicating that the institutions are buying the stock aggressively, and ideally a buy signal in Chaikin Analytics. So Activision is our poster child. Power gauge turned bullish in late January. The stock was trading around 22. And almost immediately, the stock started outperforming the market. So now the market was agreeing with the model. That is critical to the Chaikin methodology. Because no matter how good your fundamental research is or your quantitative model, if the market disagrees with you, the market always wins. So I love to see a stock with a bullish power gauge that's outperforming the market. And then I want to see money flow telling me that the institutions are buying it. Now, if James Romelli in the Alpha Shark trading room sees unusual options activity, that's just a bonus. And that can help you get into some really timely trades. And then here we have our oversold buy signals, which come on an 8-day low. I owe this one to Larry Williams, who was sort of a mentor to me in creating Chaikin money flow back in the early 70s. But these timely entry points are great for swing trading and options trading. Our oversold signals and our money flow signals tend to last for 5 to 10 trading days. So they're good for options traders who are trading short-dated options. They're good for swing trading. But they're also good for getting you into moves that you might otherwise not get into. And that's why I spend so much time on the proof points. Because look at what happened to Activision after they reported a better than expected quarter back in late October. The stock spiked way up to make a new all-time high and then sold off over 10%, at which point it made an 8-day low and triggered an oversold buy signal. If you don't believe in this methodology, are you likely to pull the trigger on that trade? How many of you have experienced what I've experienced and had the perfect setup? In this case, bullish power gauge, outperforming the market, strong Chaikin money flow, and a buy signal, and not pulled the trigger. If you've experienced that kind of frustration, please type a big F for frustrated in the chat box. That's why I stress believing in a methodology. It doesn't have to be this methodology. It has to be a plan and a methodology that you believe in. Because when you believe in a methodology, you've got conviction and confidence, and you will pull the trigger on a trade. It's so critical to making money in stocks and options. Now, on the sell side, and again, I stress that I think 2016 is a year of living dangerously. You've got to avoid the losers. Bearish power gauge rating, relative performance to the market is weak. Chaikin money flow is red, not green, indicating the institutions are sellers, not buyers, and a sell signal in Chaikin analytics. So here's Kinder Morgan in the energy sector. Power gauge was bearish all through 2014 on this stock. Went neutral, and then in February of 15 it went bearish again. And starting in early May, both the market in the form of relative strength and the power gauge were in sync. The institutions were aggressive sellers of the stock. That's why James says when he gets unusual put activity, he wants to check the Chaikin money flow. And in this case, if you saw unusual put activity in Kinder Morgan, it would have encouraged you to get into that put trade. And we've got our overbought sell signals, which come on 8-day highs when you're in a downtrend with the power gauge bearish. And I've circled these last two sell signals for a reason. Kinder Morgan dropped from 48 all the way to 15. And if you saw a sell signal at 24, you might have said, well, it's too late to short this stock. It's already down 50%. Here's a very important takeaway from this afternoon's webinar. It's never too late to short a stock where everything is lined up against it. And this is in a bull market. Now, it's been a bear market for energy, but imagine what stocks like cloud computing stocks and things like Tesla and all the stocks that have hurt people along the way in 2014 and 15. Imagine what they're going to do in a bear market. They're going to go down 90%. They did it in 2008. They did it in 2000. They did it in 1973-4. That's why having lived through 10 bear markets gives me the confidence to preach this methodology for you. You can do this if you follow the discipline. Is it going to work every time? Absolutely not. But if you follow the discipline of avoiding the bearish power gauge stocks, particularly those with negative money flow that are underperforming the market, and focusing your long positions on the bullish stocks, you are going to improve your results. Now, where do you find these stocks? Well, we've got a series of lists that we call Chaikin hot lists, and we've enhanced them recently. And in those hot lists, we have featured bulls and bears. So we have classic bulls and bears that we've just looked at. We've got bullish and bearish turnarounds, which are newly minted bulls or bears, and they're updated every night. But you can also find these stocks with our new stock screener. Now, the stock screener puts you in the driver's seat. It puts you in control. So this afternoon, I ran this screen to find potentially bullish stocks to buy on this sharp news-driven pullback that we've just seen. So what did I do? I started with the Russell 3000, and I said the power gauge rating had to be bullish. That immediately brought me down to 357 stocks. I wanted a rising long-term trend. So in the price level factor criteria, I put in rising above a rising long-term trend, and I narrowed it down to 135. And then those two technical indicators that we talked about, money flow and relative strength, I required that they be strong, and that got me down to 54 names. And then I filtered out anything that wasn't mid-cap or large cap, and I got down to a very manageable list of 20 names. And in the Q&A, I'll show you how you can save that list and monitor it for the buy and sell signals. But when you look at this list, you see some interesting names. First Solar, which was a leader in 15, is likely to be a leader again. Again, Barron's singled it out. Goldman Sachs singled it out yesterday, put it on its priority buy list. It was up 8% today. We've had a bullish rating on First Solar for about 3 months. You've got Tyson's Food, Valero Energy, one of the refining stocks in the energy sector that's doing well. You've got some more conservative stocks like Kimberly-Clark and Dr. Pepper because the market's a bit defensive. But you've also got some gas distribution companies like Atmos and Nicor. So an eclectic list. Intel's on there. Laclede, which just took over or is in the process of taking over Airgas. It's a nice 20 stock list. You could filter this down any which way you like and generate a list like this in seconds. And we'll see that to find buy ideas. Key here is that you're in control. This screener helps you find stocks that meet your criteria. Now, the second point on my checklist is to buy strong stocks in weak industry groups and avoid weak stocks in weak industry groups. The reason is that Zacks, Investors Business Daily, Standard & Poor's have all documented that strong stocks and strong industry groups give you a tailwind that improves your profits, but weak stocks and weak industry groups create headwinds, which makes it very difficult to make money on the long side, but reverse that and they become great shorting opportunities. So how do we determine whether a group is strong or weak? Well, we look at relative strength, but we have something unique in Chaikin, which is our power bar index. So you can go into our list manager and start out with the way the institutions invest, top down. Everything we've been looking at up to now is bottom up. Bottoms up means I want to find bullish stocks and bearish stocks to trade. Top down means I want to see where the best potential is. Now, most people measure potential on sectors and industry groups by price momentum. We have a way to look under the hood, and that is our power bar. So right now the market is very defensive. How do I know that? Because the only sector in the S&P 500 that has more bullish than bearish stocks are the utilities, followed by healthcare and consumer staples. These are what's known as defensive sectors. When they are at the top of the list, it means the market is cautious. At the bottom of the list are the usual suspects: energy, industrials, materials, consumer discretionary as well. And there's an anomaly because some of the very strongest stocks of the last 6 months, like Google, Facebook, Amazon, are in consumer discretionary. So when we look at the charts, we see that consumer discretionary ETF, the XLY, has actually been performing quite well. It's been outperforming the S&P for over a year. But that's because this is a capitalization weighted index, which means that Amazon, Google, Netflix, Facebook have an outsized influence on the price action of this index, because those are the largest cap names in the index. Under the cover of strength in the consumer discretionary are the retailers, which are also part of the consumer discretionary index. This is why I say it's so important to have an effective way to analyze groups and sectors, because while consumer discretionary includes retailers, you didn't want to be long retailers even when consumer discretionary was making new highs because there are more bearish than bullish stocks, and the retailers have been underperforming the market since mid-July. So the XRT was a great place to be short. And a number of our relative strength sell signals would have been very profitable in the options market. And you certainly would have wanted to avoid stocks like Macy's. So right before Macy's reported earnings back in early November, we had a money flow sell signal in a stock that had a bearish power gauge rating, underperforming the market, where you can see the institutional selling that's taken place since April. It's not a surprise that Macy's and Nordstrom's reported bearish earnings, and you can take advantage of this by buying put options ahead of earnings in stocks with a bearish power gauge rating and negative money flow, because the likelihood is you'll get a negative earnings surprise. Now, when that stock is also in a bearish industry group that's underperforming the market, now you've really skewed the odds in your favor. Again, will you make money every time? No. That's why James's advice to never risk more than 5% of your capital on any given trade is the perfect discipline. It's a risk management discipline. So if something goes wrong with that trade, as they sometimes do, you may lose 4 or 5% of your capital, but when they win, as with Macy's, which dropped from 50 all the way down to 37 in just a week, you can make outsized returns of 3 to 5 to 700% on your investment in that put option. Now, energy has underperformed now since September of 14. And even when energy has rallied, because the price of crude oil has rallied, it's still been underperforming the market. Excuse me. We look back over 26 weeks. We smooth this indicator so it doesn't whipsaw. And there's no indication based on relative performance of the XLE that energy has bottomed out yet. This in spite of the fact that crude oil jumped $4 based on the tensions between Iran and Saudi Arabia. So that's our second checklist point. Third one is to use Chaikin relative strength and money flow to confirm the power gauge rating. Now, this is what we call our new dynamic duo. In previous webinars, we've said that the Chaikin power gauge and relative strength are a dynamic duo, and they are. They help you find big winners and losers. But this combination of money flow and relative strength also helps you find big winners and losers, with one proviso. Relative strength stands alone as a bullish or bearish indicator. So Amazon has had a neutral power gauge rating, but it's been a stellar performer. It was down a bit yesterday and today, or more than a bit. These are the momentum stocks that you have to be careful with. You can make an awful lot of money trading them from the long side if they're in an uptrend, but be mindful that you need a safety net, which is a stop loss and some sort of risk management. And then Chaikin money flow, which tracks institutional buying and selling, can tip you off to some very big moves. So here's an example of where the dynamic duo is very strong. It's First Solar, a stock we found in our stock screener. Then Goldman Sachs recommended yesterday, and the stock was up almost 8% today. Actually up more than 8% because I took this chart at around noon. Power gauge has been bullish continuously since late September, and in mid-October, First Solar started outperforming the market, and then it pulled back and we got a reversal buy signal when the stock dropped below a short-term moving average and then went back above it. Think 8-day exponential. Went below that's 8-day exponential and then went above it. They reported better than expected earnings. The stock spiked up. Money flow has been very strong. And this was a stock where you just had to buy the dips. And Goldman Sachs is recommending it with a price target of $80. So this is a pretty attractive stock, trading at 71 here. Now, here is a stock like Mason, which is in the asset management business, where the dynamic duo is working on the downside. In this case, the power gauge is neutral. It had been bullish, but the relative strength and the money flow are your dynamic duo. So you look for sell signals or unusual options activity to establish a short position or a put position in a stock like Legg Mason. And here again, with the market basically flat today, Legg Mason made another new low, down 2.5%. And these are the stocks that you must avoid in 2016. If you'd followed the discipline of money flow and relative strength and a neutral power gauge being a bearish combination, and then those relative strength sell signals, you'd be very happy to have been out of Legg Mason at about 52 on the way down to 35. Now, one of the keys to keeping money and avoiding being stubborn is to spot personality changes. Now, we define a personality change as a stock that's been outperforming the market that begins to underperform the market, or vice versa, a stock that's been underperforming the market that starts to outperform the market. Now, why is that important? The worst thing you can do on Wall Street is to be stubborn, to put your feet in cement, to not recognize that a stock that you've fallen in love with has changed character. Relative strength is truth serum. It's the ultimate reality test. So here's Potash, very large fertilizer company, that had been outperforming the market with a neutral power gauge. And back here in late February, it started underperforming the market. We call that a bearish personality change. And then the power gauge turned bearish, and money flow was weak. So isn't this a stock that you should have avoided all through 2015? The stock dropped from 32 all the way to 16 today. Again, another stock that was down 2.5%. And we've been featuring Potash in every webinar we've done for the last 6 months as a stock to avoid. Now, here's a bullish personality change that's happening right now. Mylan Labs, generic drug manufacturer, got caught up in a lot of takeover machinations. They try to take someone else over, someone tried to take them over, Teva Pharmaceutical. None of that came to pass. And the stock took a big pounding. But it's rebuilding, and the power gauge has turned bullish again with very positive money flow. Notice how money flow was green when the stock made its ultimate low here in October. That's a tip-off that we're going to talk about on the next slide. We call that stealth accumulation. Money flow should have gone red, it stayed green. And now the relative strength indicator is just starting to tick into the green. So this is a personality change happening as we speak in real time. And when I pulled this chart, Mylan was up $1.61 earlier today. With all that positive money flow, you want to buy this stock on weakness because you're seeing a personality change in real time. Now, the final way we use Chaikin money flow is based on the fact that institutions like to fly under the radar. Just as James told you that when institutions want to accumulate stock quickly, they go into the options market, but that's public information. When they want to own stock and buy it, they need to buy it over a number of days because the stock market is not always as liquid as the options market, something James pointed out. So institutions fly under the radar screen by parceling their orders out over a couple of days or weeks, if a big institution like Fidelity. But you can monitor their buying and selling, that what we call stealth buying and selling with Chaikin money flow. So here's two examples. Red Hat is a software distributor of a Unix public domain software. And look at the accumulation in Red Hat here in September, October, November, and December. Power gauge was bullish off and on. It was outperforming the market. And you got a wonderful pullback from 82 all the way down to 77. Chaikin money flow stayed positive. You got oversold. That's what we call stealth accumulation. Those are golden opportunities to buy a stock along with the institutions. It's as powerful in its own way as the unusual options activity that James monitors. Here's stealth distribution, Nordstrom. If you were long Nordstrom between April and September, you aren't looking at Chaikin Analytics. The power gauge was bearish, and what were the institutions doing? By now, it should be apparent to everybody on this webinar that they were selling this stock whenever they had an opportunity. Whenever there was a buyer, they were selling it aggressively. And along the way, you got 3 overbought sell signals. And then, just as Macy's disappointed in early November, 2 days later, Nordstrom's disappointed and gapped down from 63 all the way to 50. And by the way, very often stocks will rally as Nordstrom's did the day before they report earnings if they're in a downtrend. It's sort of wishful thinking and some short covering. But the bottom line is stealth distribution is a very powerful pattern. You can see Chaikin money flow on any of your platforms. You can see it on stockcharts.com. What we do is put it all in one place. You've got the power gauge rating on the left. That's the fundamental. It's at the bottom of the chart so you can see how it's done for the last year. Decide whether it's right for your style of trading. You've got the relative performance right there. You don't have to compare 2 lines. We turn it into a heat map and the money flow and the signals. It's all packaged up for you. And now you've got a screener to find the stocks that meet your criteria. So the fourth point on my checklist is to improve your exits and entries with Chaikin buy and sell signals. Google is a perfect example. The power gauge has been bullish since July when it gapped up on a big earnings report, but there were plenty of opportunities to buy on weakness in a stock that was outperforming the market. And the most recent example is the pullback that we had in mid-December. And here's where I stress discipline and confidence and conviction. If you trade on a disciplined methodology and you believe in it and you know that if you repeat these trades over and over again, the probabilities are on your side, you'll take that trade. So any trade or investment that's based on a discipline that uses analytics gives you conviction. You'll pull the trigger, and it's a heck of a lot better than trading on your emotions. Now here's a bearish signal on Zillow. Power gauge has been bearish forever on Zillow, the real estate website that took over Trulia. Big darling of Wall Street. Stock peaked at 40 in February. It was underperforming the market. The power gauge was bearish. Institutions have been selling it. Periodically you get these rallies. God knows what they're based on. Maybe they're takeover rumors. Stock went from 21 to 34. Now, in one of these webinars, someone said, well, that means the power gauge doesn't work. And I said, no. It means I'm sleeping better at night because I don't have to worry about what happens when Zillow turns down from 34 and goes down and makes new lows. And sure enough, after a reversal sell signal coming into today, Zillow was down 2% in a market that ended higher. So follow the discipline of the signals and your trades will be more profitable. The question then comes up, well, where do you find these signals? And actually, this is today's dashboard. I neglected to change the date. This is a dashboard that shows the signals that were generated in a stock list that we call My Stocks. Everybody in Chaikin can create unlimited numbers of lists. But I follow about 150 names, which is way too many for most of you because I write a market letter and I do webinars, and I'm looking for examples from stocks that I know well. So today, WBA, which is Walgreens Boots, had a reversal sell signal, and it was down over 2.5%. I highlight that because this is a stock that is actually a big darling of Wall Street, but the power gauge is bearish, and it triggered a sell signal. So every day you can come in and see the stocks that are triggering buy and sell alerts, monitor the options activity, or just go into that trade. One of our new users said, goldmine of profitable ideas. In the first 2 days using Chaikin Analytics, I more than paid for my annual subscription. In my second week, I made over $15,000 on 3 earnings plays, and we're going to look at earnings plays in a minute. I highly recommend the system to other investors who want to save time and improve returns. I consider it a goldmine of profitable ideas. This is someone who had been using the system for just 2 weeks. Part of the reason that's possible is we do a lot of trading to get you up to speed. Now, the final point on my checklist is to find winning trades during earnings season. I know James in the trading room has had a lot of success combining options flow, unusual activity with stocks that are due to report earnings. And Chaikin is your GPS during earnings season. A lot of people are reluctant to trade during earnings season because stocks become very volatile, and that is actually not unfounded caution unless you have something like the power gauge rating as your GPS. So here's our poster child for how Chaikin can help you. This chart ends in October of 14, not 15, before Netflix had that huge run up over 700 and split. But we had a sell signal in Chaikin Analytics back in October of 14 with the power gauge bearish right ahead of earnings. We put out a sell recommendation. People who bought out of the money puts made over 50 times on their money in one day, but someone who was a little saner said, quick $21,500 profit using the upcoming earnings ideas in Chaikin Analytics. Netflix had a bearish rating, bought 3 put contracts, $22, sold them the day after earnings for $93.90, quick $21,500 profit. So here are some recent examples of potential earnings plays that you could have found in Chaikin. Microsoft, bullish power gauge rating, outperforming the market, very positive money flow, at the top of the band, not a spot that I normally like to buy it, but lo and behold, better than expected earnings, and the stock spikes up from 47 all the way to 54. That's what happens when everything is lined up. The probability is for a positive earnings surprise. Kinder Morgan is your poster child for a negative earnings surprise on a bearish stock. So right before their last earnings report, we had an overbought sell signal. Stock was around $23.50, traded down to $15 when they reported negative earnings surprise, likely dividend cut. They did cut the dividend because cash flow is tight. So now you know my checklist for finding winners and losers. I'm going to give you a bonus point for the checklist. 2016 is a year that defense will matter because volatility is going to pick up. And in a volatile market, it's the stocks you don't own that matter. So here are some examples of stocks you don't want to own. Chipotle, they're in the throes of a nightmare for a restaurant chain. E. coli, they don't know where it came from. Jim Cramer said on TV this morning he was in a Chipotle restaurant. He was about the only person in there. This is a company that's hurting. The power gauge rating turned bearish when it gapped down to 650 from a high of 750. And this is why I say you've got to go with the discipline because the stock went from 650 to 450. If you hung on based on hope that the stock would rebound, the relative strength told you you were in the wrong place. And then on that little rally up from 585 to 625, you got a money flow sell signal. Take advantage of it. 625 down to 450 is a nice trade. The swing trade in 5 to 10 days was 625 down to 525, and then you went an additional 75 points lower. So Chipotle is a stock you want to avoid. This is typical of what you need to be on the lookout for in 16. Sun Edison in the solar industry. If First Solar is the blue chip in the solar industry, Sun Edison is the poster child for everything that's wrong in solar stocks that don't generate cash flow, that have weak balance sheets. And it's a stock with a very high price to sales ratio. How do we know that? Because the factor is right here and it's all the way to the left in the red zone. And it has been under distribution since mid-July when the stock was $24. on the way down to 3.5. Bearish power gauge, negative relative strength, market agrees with the model, institutions are sellers. Anytime you get a chance to sell that stock on a rally, you want to do it. It's never too late to sell a stock where everything is lined up against you. And now let's end with two sort of well-known favorite stocks. Twitter, here's an example of stealth distribution. You were in that sideways box for 4 to 5 weeks, but money flow stayed negative. It had just had a bearish personality change, negative power gauge rating, and it broke down. And it's continued to make new lows. Triggered a money flow sell just last night. It was down another 2% today. These are the stocks where if you play good defense, you're not bottom fishing, and you're looking actually to short these stocks to turn landmines into gold mines. And then finally, Apple. We've been saying since late September, actually even before that, since July, that Apple was dead money. It wasn't a place to look for profits. It was a place to look to take profits. Now, the power gauge happened to turn bullish right at the bottom in August, very briefly, because there was an unusually heavy volume and it turned the power gauge bullish. But here's a stock that's over-owned. Everybody who wants to own Apple already owns it. The Jim Cramers of the world are looking for excuses to stay with it. He's come up with 5 acquisitions they should make to get the stock moving again. The bottom line is the money flow is telling you that the institutions are not believers. And just today, there was an announcement that Apple is likely to be cutting their iPhone production by 30%. This is a place where you can play defense. If you're long Apple, write call options on any rallies to protect your position or bring in some income. Buy a put to protect your position, or just get out and switch into something like Google, which is much more likely to outperform the market, and it'll cause you a lot less pain. And Apple actually traded down to a new short-term low today on the rumors of a cutback in iPhone production. So these are all examples of playing good defense, which is going to be critical in 2016. You got to stay away from the bears. So we got this testimonial. Chaikin has not only been profitable, but perhaps more importantly, has kept me out of many stocks that I may have otherwise purchased. We get this kind of testimonial all the time. It's the stocks you don't own that matter. So having seen this combination of fundamental and technical indicators and the patterns that are so easy to monitor, what are your next steps to success? Well, first of all, reserve your free professional training session now. Start getting our daily and weekly market insights. Sign up for your personal coaching sessions so you learn about the system and apply the Chaikin methodology to your nest egg today. The time is now. It's 2016. We've had a little bit of a sell-off. We're probably going to start rallying soon. Have a discipline and a methodology you believe in. So Chaikin Analytics now includes the stock screener and options play, which is a way to find options ideas on stocks where you have a bullish or bearish opinion, or where the Alpha Shark trading room may have identified unusual options activity. So Chaikin Analytics is normally $1,950 a year for both iPad and desktop. As a webinar special, $200 off, bringing the price down to $1,750. You can go to chaikinanalytics.com/shark, and this offer expires Friday, January 8th. Or you can email sales@chaikinanalytics.com or dial the number that's on your screen, 877-697-6783, and I know Joe is typing in the link, which is populated with that $200 discount. So what do you get for $1,750? Well, you get to turbocharge your profits. $995 in added value. You get the weekly Market Insights newsletter that I write and John Schlitz's daily morning insights. And by the way, if you had been a subscriber heading into Monday, August 24th, John would have told you that the futures were down 1,000 points and you would have known not to put in market orders to sell ETFs. But you also get the stock screener and options play fully integrated, those free small group coaching sessions to get you up and running quickly, because it's important to know what features there are and how to use them, and then subscriber-only open forums. We had one yesterday. We had about 250 people on there. Gives you the opportunity to ask questions to Joe Bicella, John Schlitz, Eric Chaikin. Sometimes I'm on there. We're all about service. We don't want to give you a product and walk away. So we got this testimonial. Thanks for making my life easier. I'm writing to tell you how absolutely incredible Chaikin Analytics has become. It started great, but with the options and screener additions, I feel it's absolutely the best product on the market. I've recommended your product to all my investing friends. It doesn't get any better than this. Thank you, JD, because this is a really powerful addition to Chaikin. And here's an example of that. I mentioned that in this week's Market Insights, my bearish stock of the week was an ETF, the Russell 2000 IWM, based on the fact that I felt the market might rally for the first 3 days of the month, which it didn't, went down. And on that rally, I was recommending buying the February 108-113 put vertical spread, because Options Play told me that that was a highly ranked risk-reward ratio trade with the potential to make almost 200% profit if the IWM traded down to 108 by the February expiration. Well, it almost got down to 108 yesterday. But this is a trade that I would still put on if we rally up over the next week or so. But with Options Play, it was very easy for me to see, because they suggest 3 different trades. You can short the stock, you can buy a put outright, or you can do the spread. And in this case, the spread had a much better risk-reward ratio. It's all about probabilities. So this Options Play capability, which we've bundled in, normally Options Play sells for about $25 a month. So there's an additional $300 saving. That's part of that $995 saving. Now, back in July, in my Market Insights, I made Yelp my bearish stock of the week right before earnings. It gapped down, and we got this testimonial netted $17,400. I found more success in the past 2 weeks using Chaikin than I've had the rest of the year. I had the biggest winner of the year today on Yelp earnings based on Mark's bearish play of the week. I risked $7,000 and made $17,000. And Mike T had only been with us for 2 weeks. Those onboarding sessions got him up to speed. Now, he's obviously a sophisticated options trader. I think he sent us his Interactive Brokers trade blotter. But using our Options Play module, you can find the same put options that Mike T found. So I'd like to end by asking you this question. If all Chaikin Analytics could do was help you find the Activisions and the First Solars of the world that are likely to outperform the market in 2016, how much would that be worth to you? If all Chaikin Analytics could do was help you avoid the Kinder Morgans and the Potashes of the world, or find a put trade on a stock like Yelp, wouldn't that be worth many times the $1,750 reduced price? Well, if you believe that, my question to you is, will you be our next success story? Will your testimonial be in my next webinar deck? You can go to chaikinanalytics.com/shark. And as a fast action bonus, if you subscribe by midnight tonight, we're going to take an additional $100 off the price of Chaikin Analytics, reducing the cost to only $1,650. And we're going to give you 2 additional bonuses. Bonus number 1 is an exclusive ebook that analyzes the 20 factors in the Chaikin Power Gauge rating, the most important factors to look at when analyzing stock. And bonus number 2 is a one-on-one half-hour phone call with either John Schlitz or myself. We'll do everything but discuss individual stock recommendations. We'll talk about your strategies, what you've been having trouble with, what you'd like to work on, how to develop a discipline, and so forth. So if you believe in this methodology as strongly as I do, and I came out of retirement to build the Power Gauge rating and launch Chaikin Analytics, please take advantage of this fast action bonus. Subscribe by midnight tonight. Go to chaikinanalytics.com/shark, and this $300 discount will be automatically applied, and you can start applying Chaikin methodology as early as tomorrow, because Joe Bicella, who's going to take over the webinar for the Q&A now, does daily onboarding sessions. May only be 3 times a week, but we've had 30 to 40 people on because so many people subscribed in the last month to Chaikin Analytics that Joe's been a busy guy. So Joe, I'll hand it back to you, and I'll boot up the desktop app.
Great. Awesome.
So that we can answer any questions. And I'm going to put up PMCS, which was one of the bullish options activity trades that James talked about, because I want to show you that when James saw that unusual call buying back on October 1st, the Power Gauge rating had just turned bullish. So there's where the Power Gauge rating and the unusual options activity meshed. And when you've got 2 edges in the options market, you've really got the wind at your back. So Joe, see if there are any questions that you can call out or stocks that people want to look at. And I'm going to go on mute for a second just to clear my throat.
Absolutely. Well, Mark, thank you very much so far. And everybody, thanks for submitting your questions. I know it's been a hectic day so far, but we're going to go through. I see Mark has pulled up his screen right now. There's a few questions I know I can get to right off the bat. We do have 6 pairs of buy and sell signals. I saw there's a question about
Joe, we're having a little trouble hearing you, so if you could try and adjust your mic, that would be great. I know you're in an unusual place because of the fire drill in our building.
How is it coming through now, Mark?
That's better. Thank you.
Great. Sorry about that. Let's see. 6 signals, 6 pairs of buy and sell signals are available. Mark, would you be able to show us where you can access them in the past if you wanted to pull up any?
Sure. Let's go into my stocks list and we'll look at Valero. If you click on these red-green triangles, you see the 6 pairs, and we deliberately don't put them all up on the screen because it would be a hodgepodge. Some people have asked us why we don't do that, and the reason is it would be a nightmare of signals and you wouldn't be able to make them out, but you can choose any one signal, and I've just picked the relative strength buy signals, and see how effective they would have been in one of the only energy stocks that made new highs at the end of 2015 instead of new lows, Valero Energy. Still with a bullish Power Gauge rating, up almost 2% today. So there are your relative strength buy signals. If you want to see all the signals in a list, this is our desktop app. We've got a little bell here. And here are all the stocks that I follow that gave buy signals coming in today. Now, Raytheon is in the aerospace defense group, which is strong. It made an 8-day low, so we got an oversold buy signal. If you were following Raytheon, you would have known about that. Here are the bearish signals that triggered. So I mentioned WBA, which had a bullish Power Gauge rating for most of 2015, just turned bearish and triggered a reversal sell, and the stock was down almost 3% today. Now, another way to find the signals is to go into our user lists. You go to Chaikin Hot Lists, click on Signals, and each of the signals is individually arrayed. So if you want to see all the stocks in the Chaikin universe that triggered relative strength buy signals yesterday, here they are. Since the market was oversold yesterday, let's see, 42 stocks triggered oversold buy signals. One of them is Tyson's Food, which is in our unit investment trust, in the First Trust Chaikin low beta growth portfolio. Great opportunity to buy what has been a very strong stock on weakness. And we can see that the previous oversold buy signal works. So a number of ways to see the signals within Chaikin.
All right. Mark, would you mind pulling up Twitter, and would you be able to demonstrate options play for Twitter?
Sure. So here's Twitter. It's in a downtrend. Stock just triggered a money flow sell. So we click on options, and three choices are going to come up. These are suggested ideas. You can short the stock, which has a green circle around it. That means that it's a good risk-reward ratio. These are all based on standard distributions and implied volatility. You could buy a February 22 put option. It's just barely at a 99. Or the preferred trade with the check mark is to do the February 22, February 17 vertical put spread. Cost you $172, which means you're short Twitter at 22, closed at 21.92 today. I'm sure earlier in the day that would have been a choice, and that would have been very profitable by the end of the day. And the risk-reward ratio is beautiful. It's a potential 200% return, and you know what your risk is. And if you want to see in plain English where your break-even points are, or what this trade's all about if you're a novice options trader, this is a bearish strategy with a limited risk of $172 and potential of 328. And it'll profit if the stock closes below 2026 by February 19th with a 43% chance based on probability distributions that this will happen. Now you have an additional edge here because the power gauge is bearish and it's underperforming the market. So if you had been looking at Twitter going into today's opening, this trade would already be profitable if you had put it on.
Now, we have a few questions when it comes to finding stocks that you can trade earnings on. I think what might be helpful, I see you're going to the screener. How about we show how you can search for stocks with reporting earnings in a given week?
Now, this is the beginning of earnings season coming up next Monday when Alcoa reports after the close. There aren't that many earnings due out this week, but one of the ways you can find them is to say, I want to look at the Russell 3000. I'm going to turn my global filter on so that I'm filtering out stocks under $20 that don't trade very often with a market cap of less than $2 billion. And that immediately reduces the Russell 3000 down to 1,000 names. Now, if I go down here, I can say I want to see all the stocks that are reporting earnings within the next week and rescreen. And because it's a slow earnings week, there are only 14 stocks. Walgreens is one of them. Now, Walgreens might have reported after the close today, but clearly the stock was down ahead of the earnings report with a bearish rating. You also have Constellation Brands, which is a liquor company, hard spirits and wine, buying up a lot of stocks. But that's how easy it is to see which stocks are reporting. Now, if you're into the middle of earnings season, as you will be next week, you can say, I want to see stocks that have a bearish rating that are going to report next week, and now you're going to narrow your universe down even further. Now, I said you could save a list, but a small list isn't all that exciting. So let's show you what you can do with a bigger list. So let's say you're looking for put candidates in large cap stocks. Now, how do we do that? We'll define large and mid cap stocks in the Russell with bearish ratings. We'll take out the earnings filter. And now we've got 285 stocks. Now that is admittedly a very large list to monitor. So let's require that money flow be weak and relative strength to the market be weak, and watch how we reduce 285 names down to 112. And remember I said price to sales is one of my favorite ratios. So let's say that we want to see stocks with a price to sales ratio is weak, meaning that you're paying too much for a dollar of revenue. Now we're down to 75 stocks, and I'm going to reduce it further by requiring that they be in a downtrend. So I want them to be under a falling long-term trend, and in less than a minute I've gotten a list of 33 names. Now look what I can do with it. And you see Nordstrom on there, which we looked at earlier, Twitter, Kansas City Southern. You can see how this is doing the work for you, and it's customizing it to whatever you want to look at. So I say save list, and I'll call these webinar bears. Click on view in my watch list, and it'll now take me back to the workspace, and that list is now populated. I can go into our panel view and sort that list by percent change for the day to see where the strengths and weaknesses are, and I can start monitoring it for signals. So if I see a sell signal come up on this bearish list, I'm going to get pretty excited. I can also loop through the charts, and look how easy it is. We say we save you time to loop through those charts. We're going to bring up the chart to full screen, and within seconds I can loop through this list of 33 names, looking at the chart patterns, seeing if the signals worked, looking at the money flow. It's one of the great productivity enhancers, and productivity in trading leads to profits, because if you can focus on the trade instead of the analysis, you're way ahead of the game. And this is how easy it is to find these stocks. Here's Restoration Hardware, which had a really negative earnings report that killed the stock. And it's a stock that we were bearish on ahead of those earnings. It was our bearish stock of the week about a month ago. So you can use the screener to customize a list of stocks to your own requirements, bullish or bearish, and then start monitoring them. So let's say you had created this list yesterday. Here are all the sell signals in this list coming into today. Twitter, Kansas City Southern, Tiffany. Now, Tiffany is an interesting case because luxury goods, China, don't mesh very well right now. The stock's been in a downtrend. It just got overbought with negative money flow. Interesting stock to look at only on strength on the short side. But that's the point here. You can find those signals in the list that you've created and keep monitoring day by day to see when they crop up. And that's what we're all about, trying to focus you on the best opportunities in the least amount of time. So Joe, I think we've got time for one more question. People have been on the webinar for quite a while, and we'd love them to get on with their evening.
All right, great. And I see there's, again, a lot of questions today about signals. Would you mind just clarifying when signals are triggered in our program?
Well, we have 6 pairs of buy and sell alerts. 4 of them are filtered by the power gauge rating, meaning that for anything but the 2 relative strength signals, the power gauge rating has to be bullish to trigger a buy signal or bearish to trigger a sell signal. And then we have some technical patterns. Now, they're fully explained in our manual, and we've got a user guide. So if you click on the user guide and go into signals, you'll see each of the 6 pairs of buy and sell signals explained one by one. So an oversold buy is a stock that makes a new short-term low, becomes oversold while the power gauge is bullish. A reversal buy occurs when a stock crosses over its short-term trend while it's been underperforming the market and the power gauge is bullish. That's why we call it a reversal. It's been underperforming. It starts to move back into an uptrend, but the key is the power gauge is bullish. So all of this is fully explained in a very accessible desktop guide that talks about the definitions and the overview and when they're calculated and so forth. So full disclosure, transparency, no black box. It's all there for you. So by all means, take advantage of this special offer. Subscribe by midnight tonight, $1,650 plus these two bonuses. It just doesn't get any better than this. So if you believe in what we've been talking about, by all means take advantage. Subscribe tonight. Joe will be on your case to get you onboarded tomorrow. And that's really what we're all about, trying to get you profitable. We call Joe and his department our customer success department, and he's done a great job of it. So Joe, why don't you wrap up? And thank you, everybody, for staying on with us.
Excellent. Well, Mark, thank you very much for your time this afternoon for the presentation. Both presentations tonight have been recorded. We'll be sending out a copy of this for anyone who registered for today's session. Again, make sure to take advantage of Mark's offer, $1,650 for a full year to Chaikin Analytics. Like Mark said, step one, subscribe. Step two, attend my onboard session. We'll show you all the ins and outs, put you in a position where you know how to navigate through the program and how to find stocks that are relevant to the strategy you're trading. So I want to thank everybody again for attending tonight's session. Have a fantastic evening, and we'll see you soon.